We've seen strong demand in 2022 for gold. Of course, one factor, surging inflation and the invasion of Ukraine. Demand for the stuff is said to be up 34% in the first quarter of this year. We're joined by Juan Carlos Artigas, Global Head of Research at the World Gold Council. Thanks very much indeed for joining us. I think we have a chart showing the components of gold demand, but it's up. What has been driving the increase?
Hi, Andrew. Thank you so much for inviting me. It's great to be here with you. And as you mentioned, I think that one of the key drivers here has been risk in the form of high inflation, quite persistent and increasing, which not only is a continuation of the trend that we saw from the end of 2021, but it has been exacerbated by geopolitics and the impact, the knock-off effects that the war in Ukraine have had on commodity prices, but just also more generally on the global economy, supply chain disruptions, and so on.
We've seen a major increase in flows into ETFs in recent years. Did that show up in Q1?
Absolutely, that's correct. I mean, ETFs were one of the major driving forces for the increase we saw in Q1. Roughly speaking, we saw more than $11 billion come in during Q1. And what is interesting to see from this is that during 2020, in the pandemic, gold-backed ETFs, which are one portion of global of total demand, so it's not the whole, but it's it's an interesting and representative aspect of the market. During 2020, in the pandemic, there were about $50 billion of gold coming in through gold-backed ETFs. Now, in 2021, as conditions start to normalize and the economy started to recover, we did see some outflows of about $9 billion or so. So 50 come in, only 9 came out in 2021. But now again, in 2022, Q1 has already more than erased any outflows we saw in 2021. This also signals to us that many investors that are accessing the gold market are not just adding tactical positions, but that are adding also strategic longer-term positioning as risks, whether it is inflation-specific or more generally a more complicated geopolitical environment, are increasing hedges on their portfolios.
Give us an idea of central bank buying. We have a chart from you guys. We didn't see a surge in central bank buying in the latest quarter. I guess there wasn't time for the war in Ukraine to have a big impact. But central banks are buying, but there was a very small uptick.
Yeah, but I think that it is important to understand that sometimes when we say there are some markets that are seasonal, like the jewelry market, and comparing Q1 to Q1, it may be meaningful and more insightful. But when you have a sector like central banks are not going to be seasonal, from that perspective. It's not that central banks always buy in Q1 or Q2 or Q3. So I think that it is important to understand the overall trends. And one of the things that we are seeing here is that central banks continue to be net buyers. And actually, the demand in Q1 was robust. It was more than 84 tons of gold. And it signals the fact that gold is a very well-established asset in foreign reserves, and that central banks do see it as an integral part of the way that they manage, reserves overall. And foreign reserves, in particular gold, has been an important component both in developed markets traditionally, but over the past more than 10 years, increasingly on emerging markets.
It's any particular countries piling into gold that you recall? I don't know if you can go into that much detail.
Well, yeah, I mean, there were certainly, many central banks that are standing out. I mean, one of them in particular during Q1 was Egypt, that increased their reserves. And this has been perhaps in the works for some time, so it was not, completely new. There's also Turkey that has a certain degree of active management on their reserves. And sometimes they sell, but oftentimes they buy, and they have been overall net buyers over the past several years. I think that it is really interesting to see how gold is a very well-established monetary asset, even though, of course, it's not any official currency.
we have this awful war in Ukraine. Why has gold not gone up more? Because, I mean, it's causing instability and fear throughout Europe. Gold is still stuck below $2,000 US. You would think you'd see more safe haven demand.
Well, look, I mean, I think that demand in particular, as we mentioned before, not only through gold-backed ETFs, but also, for example, on the bar and coin market, especially in the US and Europe, reflect that relevance and the fact that, yeah, indeed, investment demand is increasing. But we need to remember that gold has a dual nature. So gold is not just about investment. I know that we tend to focus quite a bit on that, and it's very normal for investors to think about gold in that context. But more than 40% of net demand comes in the form of jewelry or technology, which soften over the quarter, right? So that's one aspect. The second aspect is that, risks have increased. And as I mentioned, not only the data shows it, but our anecdotal conversations with investors suggest that gold is becoming an even more integral part of asset allocation. However, there is a headwind that gold is experiencing through higher interest rates. So interest rates are creating a headwind for gold. And of course, as central banks, in particular the Fed, but more generally central banks, are trying to target more aggressively inflation that continues to be very persistent and increase, that creates an increase in opportunity cost, not only for gold. I mean, we need to remember that as interest rates increase, that can be also a challenge and a headwind for other markets, including the equity market. So that's also one of the reasons why gold was one of the best performing assets during the quarter, right? And it served its purpose. So yeah, indeed, gold has had some headwinds from potentially higher interest rates, but at the same time, we do think that some of the underlying drivers of gold, including, as you mentioned, the additional risk, is creating support for more strategic long-term demand.
Okay, so I'm looking. So gold is only up 3% so far this year, according to Bloomberg. Oil is up almost 40%. We've got high inflation, which is fiat currency losing its value. Gold really hasn't done very much. So isn't there the case here just to ignore gold as an investment asset? It's not delivering.
Well, I mean, actually, if you look at the performance of gold, while it has come down specifically in April somewhat, it increased, especially when risks were increasing rapidly. And again, it was serving its purpose. It has a very consistent negative correlation to the stock market when stocks pull back. And that's not something that can be said of other assets, including commodities. So commodities do not necessarily generally function that way. It is very normal for commodities in a reflationary period to increase in value. I mean, remember that during 2020, they really underperformed while gold was a really strong performer, right? So I don't think that we can only focus on 2 or 3 months to understand strategic assets. And in fact, actually, our research suggests very strongly that from a strategic perspective, gold is the better asset. While, from a tactical perspective, I mean, there are going to be, of course, periods where assets such as commodities may be valuable for investors. But we do think that the combination of diversification, useful diversification, as well as long-term returns can be extremely useful, for portfolios, especially in a highly liquid assets such as gold.
Juan, thank you very much. It's always great having you join us.
Thank you so much for having me over again.
Juan Carlos Artigas, Global Head of Research at the World Gold Council.